What's up guys, as you might have heard, Hamilton came out with the first 0DTE ETFs on the Canadian market. So Hamilton, who are they? They are a Canadian ETF provider. Personally, they have my favorite all-in-one ETF called HYLD, which is very close to the S&P 500 performance with covered calls and 25% leverage. I could make a video covering that. But this is very exciting because as a Canadian investor, all of the ones we could possibly invest were on the US market. And now since it's coming on the Canadian stock market, we would be able to invest in those in a more tax efficient way. In this video, I want to cover these 3 new ETFs and just talk about them, give a quick summary. Hopefully, whether you're American or you're Canadian, this video will help you understand these and you'll learn something about these and maybe make your mind on if you want to invest in them. So what I'm going to be talking about today is what are they? So I'm going to do a quick summary of each of these ETFs. Then I'm going to go over their inception date, their price, and their current yield. Then we're going to talk about their distribution frequency, which is bi-monthly, which again, Hamilton, they always do something with their own twist. And that's one of the first thing they're doing is bi-monthly. So 2 times a month, essentially there's 12 months in a year. You do that times 2, you get 24. So very interesting. It's not weekly, it's not bi-weekly, but it's bi-monthly. So very, very interesting distribution frequency. And we're going to talk about that quickly. How they generate income. Again, this is a 0DTE ETF, but they have their own twist on how they write their options and how they write those covered calls. Then I'm going to go over how this could fit in an income portfolio as an income investor, who this could be good for. And then I'm going to give my personal opinion. And obviously anything that I say in this video is not financial advice. I'm just sharing the information and hopefully bringing value to you guys. And if you're into anything that is related to high yield income investing, feel free to follow the channel. If everyone watching this channel will subscribe, I would probably be a famous YouTuber by now. But yeah, anyways, like if you want to support me, just drop a like, a subscribe. I really appreciate it. Let's get into it. So just to give you guys a quick overview, SDAY is essentially the S&P 500 with 0DTE. CDAY is the Canadian index with 0DTE. And QDAY, as you can see from the hint here from the first letter Q, is going to be 0DTE on a more NASDAQ/tech focused underlying. Let's start with SDAY. As we can see here, ticker SDAY, US equity DayMAX ETF. Estimated distribution of 18 cents. So what are the highlights for this one? So this is Canada's first 0DTE call option strategy to maximize premium income. Flexible coverage ratio adjusted to daily target yield and attempt to preserve the upside. This is the same thing for all of them, by the way. The estimated distribution is 18 cents. And as we know, they are going to be selling covered calls. The thing with covered calls is you'll be giving up on some upside for income. But the thing here is it's adjusted daily to target the yield and attempt to preserve upside. If they need to generate 18 cents and they see that they do not need to write cover calls on 100% of their holdings, they're going to adjust and they might just write cover calls on 50% or 80%. They can probably adjust the strike price so that they will be able to get the premium that they need to pay us that distribution. So if their goal is reached, they're not going to go overboard with the cover calls. So they're going to let the investors get that upside and get the growth out of their investment as well as the income. A modest 25% leverage to enhance income and growth, actively managed by an options team with 50 plus years of combined experience led by Nick Picard. He's behind some successful income ETFs at Hamilton. You can find a bunch of interviews on him on YouTube if you're curious. So who is a good fit for higher tax efficient income? Since it's going to be 0DTE as a Canadian, these will be taxed as capital gains. You would pay tax on 50% of the distributions since it's capital gains. Much more efficient as a Canadian investor. Semi-monthly distributions, complementary income solution, and then exposure to SMVP. So that's where they're doing something different. These are the blue chip US dividend paying companies with similar performance and lower volatility than the S&P 500. And the fund objective is to deliver attractive income while providing exposure to US equities, supplementary income, as they employs an actively managed and primarily ultra short term, basically 0DTE. If we look at the NAV, it's 24.17 and the estimated distribution is 18 cents. So if we do 18 cents times 24 times a year and we divide it by the current NAV, it gives you a yield of 17.8%, so almost 18%. And if you didn't know, usually Hamilton, their income ETFs are very stable on the distribution side. So usually they always come up with a certain distribution goal and they stick with it for a few months. I know that they have a certain cushion that they keep on the side. When everything goes well and they're able to increase the distributions, they will increase the distributions. but really they have a cushion. So even during bad downturns, they usually try not to cut distributions, but it is possible that they cut them. They're more conservative and consistent, and usually they do not really cut distributions unless they really have to. So here it's a quick resume of everything we just read. Flexible coverage, like we said, so they don't have to write 100% of their holdings on the covered calls. They give you exposure to the dividend champions for less volatility, modest 25% leverage, and pays twice a month. Now, if we look at their holdings here, that is where it's very interesting. If you buy SDAY, you would be holding 100% of SMVP and 25% of Vanguard. I did research and I found an interview by Passive Income Investing, Adriano. They're writing 0DTE options on the VOO portion. So you get 100% exposure to the growth of the dividend champion index. And then they're using that 25% position for their covered calls. So they're generating that 18% yield on this part of the portfolio. So your upside will be capped on the S&P, but not 100% because they're flexible. And if they generate enough income, they don't need to write those covered calls, but you get 100% exposure to the growth of this one. So I think it's a very cool and unique way to make 0DTE, because it gives investors exposure to the growth of the dividend index, and then they use only 25% of the 125% weighting of the ETF to generate income. So you're not 100% capped. They're not like the other 0DTE ETFs where they're writing 0DTE options on 100% of the portfolio. This one is only on 25% of 125, so on about 25% of the ETF. What's cool about this is that it is the US dividend index. So if we look here, as you can see, it actually outperformed the S&P 500 in the long run, because they're the more blue chip companies, consistent dividends, and their dividends are growing. Here, as we can see, the criteria to get inside this SMVP index. It's made of companies with an average market cap of 169 billion, 10% portfolio average annual dividend growth. So high dividend growers, very stable dividends. And then companies with 25 plus years of increasing dividends with no decrease. This kind of reminds me of SCHD in a way where it has that dividend growth and it's holding those top dog dividend players in the US market. And here I did a little comparison. If you compare SMVP, which is in Canadian, to VFV, which is the S&P from Vanguard in Canadian, as we can see here, SMVP actually is still outperforming the S&P since the beginning of the year. And here in the April crash, SMVP dropped 9% compared to the S&P, who dropped 19%. So much less volatile and very good performance. So I'm very excited about this one here. Like, this is very cool. So now if we look at CDAY, the Canadian equity DayMAX, exactly same thing. Canada's first 0DTE call option strategy, flexible coverage ratio, same thing. So they are flexible with their 0DTEs. They're going to aim for that 18 cents distributions, and if they're able to reach it with writing less covered calls, they're going to do so. So then we can capture more upside in this ETF. Modest 25% leverage, a good fit for tax efficient income, semi-monthly distributions. The fund objective is to deliver attractive income while providing exposure, but not exclusively to Canadian equities. To supplement income, CDAY employs an actively managed, primarily ultra short-term option strategy, exposure to the Canadian market, and then on top of that, they will write those 0DT options to be able to pay those 18 cents twice a month. So it's the same distribution and almost the same NAV. So they will be aiming for that same 18-cent distribution as SDAY. That means that the yield is also around 17 to 18%. Then here, if we look at a quick summary, as we see 0DT options on a daily basis, flexible coverage. So they're going to actively manage the coverage ratio, generally targeting 20% of the portfolio. So that means that they were going to be writing covered calls on about 20% of the portfolio max. They can do less, they could do more. But the point of that, like I said before, is so that we can get the income that we need, not more, not less. When we're done getting that income for the month, they're going to let us capture more upside. They're going to be holding Hamilton Champions again, but this one is the Canadian version. So they're going to be holding all of the top dog dividend growth companies on the Canadian market. And that's what we're going to use as exposure for growth if you buy CDAY. Modest 25% leverage, overnight exposure, and it pays twice a month, as we know. Then for the holdings, this one is very cool as well. As we can see, 100% of the Hamilton Canadian dividend champions. SDAY was US dividend champions and CDAY is Canadian dividend champions, but they're going to be writing 0DT on the S&P 500 from Vanguard. So here, what's the deal is that you will be getting the growth from the Canadian dividend index. As we know, the Canadian market is a bit less volatile than so here, on top of getting Canadian exposure, this might be a good fit for people who want income and a bit of a less volatile position, even though the other one is still not as volatile because they are US dividend champions, but they're going to be writing 0DT on the S&P, so you still have a bit of exposure to the S&P. What is going to move the price of CDAY is going to be CMVP, So as the Canadian market grows and those dividend growers keep gaining price and paying dividends and whatever, you're going to see appreciation in your share price, and then that 25% of Vanguard S&P 500 is going to be used just to generate that 18 cents twice a month. So if we give a quick look at CMVP, so the Hamilton Champions Canadian Dividend Index, it's kind of a Canadian SCHD where they just extract those top dog dividend players. So Canadian companies with a long history of stable and increasing dividend payments. When comparing CMVP with the performance of the TSX 60, as we can see, it is clearly outperforming and less volatile, so very similar to the US Dividend Champion. And then if we look, what is this index all about? It's about companies with an average market cap of 73 billion, 10+% portfolio average annual dividend growth, and companies with 6+ years of increasing dividends with no decrease. So very, very solid companies. If we compare the total returns of CMVP versus XIU, XIU is an ETF for the Canadian total market, and then VFV is the S&P 500 on the Canadian market. As we can see here, CMVP is the clear winner, and it actually outperformed the S&P by a lot. It's very close to XIU, but similarly to the US Dividend Champion ones, during the April crash, it dropped by only 6.5% compared to the TSX 60, which dropped 11%. So less volatile and overall better returns. And then finally QDAY, so all of the same thing. Flexible coverage ratio, 25% leverage, semi-month, higher tax efficiency. They aim to deliver attractive income while providing exposure to US equities. They are going to do 0 DTE options. It is a good fit for people who want exposure to the largest technology companies in the US with an options overlay on the NASDAQ 100. So if we look at their holdings, what does that mean? It means that you get exposure. So the growth portion of this ETF will be from XLK, and then they're going to be writing those 0 DTE options on QQQM. So it's the Invesco NASDAQ 100 ETF. Particularity of this one is you get exposure to XLK. So SNK is not equal to the NASDAQ. XLK is technology specific. What is the NASDAQ? The NASDAQ is anything that is not financials and anything that is doing very well on the US market. So currently the NASDAQ is full of tech stocks because the tech stock is what is doing the best right now on the US market. But let's say in 10 years, all of those AI tech stocks, they're not good anymore. And there's another industry that blows up like biopharma or something. Then the NASDAQ will be full of biopharma, where XLK is still going to be holding those tech companies. So XLK is tech specific. So if you're buying QDAY, it's because you want some tech exposure in the long run, and you have 25% exposure to the NASDAQ, which is basically used for those 0 DTE. And as we can see here, they aim for a distribution of 20%. Since the NASDAQ is more volatile when trading their 0 DTE options, the implied volatility is going to be higher. So they're going to be able to get a bit more premium than with the S&P 500 from Vanguard. Now, if we look at the yield, 20 cents twice a month. So that means 20 cents times 24 divided by the NAV of 24 and 26. So here we're getting a yield of about high 19s, 20. So the yield of this one is going to be 1 to 2% more than SDAY and CDAY, obviously because the underlyings are going to be more volatile, and more volatility equals more option premium. But then the rest is the same, flexible coverage. So they target about 20% of the portfolio when writing those 0 DTE covered call options. You get exposure to the US tech, modest 25% leverage, pays twice a month, daily 0 DTE options, as we said before. And now if we look at the performance, so as we can see, if we compare XLK with QQQ and VOO, XLK is the clear outperformer. And the reason why is because XLK is tech specific. As we know, like tech has been taking over the world. As long as tech keeps growing and growing and growing, being very focused in tech is a good thing in the long run, and you will be getting more exposure to all of the growth related to tech, where the NASDAQ is just those top 100 companies in the US market that are not in the financial sector, where the VOO is the S&P 500 as we know. So QQQ has been slightly outperforming VOO, but really tech focused stuff, like it was the good bet to take a few years ago, and right now tech is the future. So I'm not sure why they went with XLK instead of QQQ, but I think it has the potential to offer more growth, especially if you're very bullish on tech in the future. So that was it, guys. I just wanted to give a quick run on that. So as we can see, the inception date for all of these was July 14, 2025. So now just to talk about the distribution frequency, what is the point of paying investors twice a month and not once a month? First of all, as a Canadian ETF, they're the first to do that. All of the other ones are monthly. So that is already a good step forward towards some weekly distributions that we might maybe see in the future on the Canadian market. Who knows? It's already better than monthly. And what's nice about bi-monthly, as we know, is that you can compound your shares faster. So this is more cash flow. It kind of feels like a bi-monthly paycheck. Some people Literally, that's how they get paid at their 9 to 5 job or their jobs. They get a paycheck 2 times a month or every 2 weeks. You're able to compound your shares faster and you don't have to wait a whole month. So that is the pro there. I don't really think there's any cons in getting your distributions twice a month. It's mostly pros, just the fact that you can compound your shares faster. Now, what is the role of these in an income portfolio? My personal opinion, I think that these are very good growth/income positions with a conservative yield of about 17 to 20%. The yield is not too aggressive, and knowing Hamilton, I know that they're very consistent with their distributions usually. This is a very unique approach where you will get exposure to those dividend champions or to XLK, for example, so you will get a lot of growth, and the fact that they're writing covered calls on only 20% of the portfolio, that just means that you're not going to give a lot of upside on your holdings. I think that these are going to be very unique, and if they really do what they're saying, people are going to love them. Why? Because they're going to offer a lot of upside and high income. 18%, 20% yield is high distributions, and they pay twice a month. And the thing is, they only write covered calls on 20% of the portfolio, so that is very unique. So we will get a lot of upside, low volatility because they hold those dividend champions aside from the tech one. Very, very exciting. I can't wait to see how this is going to perform in the long run. So this might be a lower beta than the S&P 500 with high income. So I'm just excited to see how this is going to play off. But yeah, my personal opinion, I think that this is very exciting, and this could fit in a portfolio for someone who already has very high yield holdings like maybe YMAX or OT, and you want to put money into an income ETF, but you also want a bit of growth in your portfolio. I think these three, SDAY, CDAY, and QDAY, could be some very good options for someone seeking for high growth and high income in a portfolio. That was it, guys. Let me know in the comments, would you guys invest in those? Personally, yes, I would invest in those, but I want to see more price history. I want to get more data before throwing my money in these, but I'm pretty confident that these will do well. Anyways, guys, that was it. Until next time, take care.